Hey everyone, welcome back to Corporate Decoder. Today we're diving into a massive SEC filing, and let's just say some of these funds might be making investors pay more attention to where their investment dollars are actually going. This report is all about shareholder information for Hotchkis Wiley funds. Think of it like a yearly checkup for these investment companies, showing how they performed, what they invested in, and how much it all cost. We're going to break down the financials for several of their funds, but let's start with the large cap disciplined value fund. Now, the first thing that always grabs my attention are the costs. Based on a hypothetical $10,000 investment in their Class A shares, the costs for the past year were $112. That might not sound like much, but it's about 1.06% of that investment. That's money that doesn't go into growing your investment. Performance-wise, they reported about 10.5% return for Class A shares. That sounds decent, right? But here's where it gets interesting. They underperformed the Russell 3000 index, which saw a much higher return of 15-30%. That's like running a race and coming in behind the pack. The report says stock picking and putting too much money into energy stocks hurt their performance. They also mention weakness in communication services, industrials, and materials, plus an overweight in healthcare also dragged them down. It sounds like they missed out on some of the big winners last year. On the flip side, they did well in information technology and financials, both in picking stocks and having a good chunk of money invested there. So they had some bright spots, but not enough to keep up with the overall market. Looking at the longer term, they also show charts for a $10,000 investment over 10 years. For Class A shares without sales charges, the 10-year average return was 9.55%, but the Russell 3000 index did much better at 12.96%. Even with sales charges, the numbers show they are consistently lagging behind broader market performance over the long haul. As of June 30, 2025, the fund had about $80 million in assets. That's a good chunk of change, but consider the Russell 3000 index performance. It seems like investors could have done much better elsewhere. Their top holdings include F5 Inc. at 5.90%, Workday at 4.5%, and Citigroup at 3.6%. These are big companies, so it's not like they're hiding in obscure stocks. And here's a leadership change note, effective July 1, 2024. Judd Peters is out as a portfolio manager, and Doug Campbell is in. George H. Davis Jr., Patricia McKenna, and Scott McBride are still on board. And a name change too. Effective August 29, 2024, the Diversified Value Fund is now the Large Cap Disciplined Value Fund, trying to rebrand or just fine-tuning the message. Now let's zip through a few more funds to see if there's a pattern. For the Large Cap Fundamental Value Fund, Class A shares cost 128%, a bit higher than the previous fund. Performance, they returned 9.62%, again underperforming the Russell 3000 index's 15-30%. The reasons sound familiar: stock selection and an overweight in energy were primary detractors. It seems like the same story across these funds. This fund has a much larger net asset value, over $369 million. But a low return and similar reasons for underperformance mean that bigger doesn't necessarily mean better. Interestingly, their top holdings are identical to the previous fund, F5 Inc. at 5.0%, Citigroup at 3.8%, and Wells Fargo at 3.1%. So similar strategy, similar results, and very similar top holdings. Moving on to the Mid Cap Value Fund, Class A shares cost $122 per $10,000, or 121% performance, a measly 1.01% return. This is a stark contrast to the Russell 3000's 15-30%. The culprits again, stock selection and an overweight in energy, with consumer discretionary materials and industrials also playing a role. It's becoming a broken record here. This fund is managing over $379 million, again, a significant amount of money, but with a very disappointing return compared to the market. Top holdings here are F5 Inc. at 4.0% and Popular Inc. at 4.0%. They seem to like F5 Inc. quite a bit across their funds. Let's check out the Small Cap Value Fund, class $121 per $10,000, or $1.2. Per $1,200, or 1.2 cent. Performance was 1.04%, again underperforming the Russell 3000. And surprise, surprise, stock selection and an overweight in energy are primary detractors. Communications services, consumer discretionary, and consumer staples also contributed to the underperformance. This is their largest fund by net assets at over $743 million. They're managing a lot of money here, but the performance is lagging significantly. Here, F5 Inc. is their largest holding at a surprising 9.2%. That's a pretty concentrated bet for a small cap fund. Next, the small cap diversified value fund Class A cost 116% performance, 0.6%. Performance 0.6%, performance 0.6%, performance 0.6%. The report points to consumer discretionary, industrials, and financials as detractors for this fund, along with an energy overweight. This fund is also managing a huge amount of money, over $730 million. Interestingly, their top holdings here are very small percentages, like Par Pacific Holdings at just 0, a much more diversified portfolio, which might explain why the performance is also muted and highly diversified across different sectors. Let's switch gears to the Global Value Fund. Class A cost $129, won $529, 115.70%. Now this is higher than some of the others, but it still slightly underperformed the MSCI World Index at 16.26%. The report mentions communication services and energy as detractors here, with an energy overweight also hurting performance. They did better in information technology and industrials though. This fund is much smaller with just under $40 million in assets. And look at that, F5 Inc. is again a top holding at 5.0%. It seems this company is a favorite across many of their funds regardless of market cap or geography. Now, the International Value Fund Class I shares, the cost here is $108 or -5%. Performance a much stronger 26.60%, outperforming the MSCI World Index. This is the first fund to actually beat its benchmark. The report credits stock selection in industrials and financials, plus an overweight in financials for their success. An underweight in healthcare also helped. This fund is quite small with under $5 million in assets. Top holdings include Siemens AG at 4.6% and Telefondopti Bolliger LM Ericsson at 4.1%. These are solid international companies. Let's look at the International Small Cap Diversified Value Fund Class I shares. It cost $110, 19.00%. Performance was 19.82%, beating the MSCI World Index again. Here, stock selection and an underweight in healthcare plus an overweight in financials were key performers. Another smaller fund with about $4.6 million in assets. Their top holdings are all around 0.6%, suggesting significant diversification within this international small cap strategy. Let's move to the Value Opportunities Fund. Class A cost $128,000, 120%. Performance was 13.31%, slightly underperforming the Russell 3000 index. Deters, again, energy, communication services, materials, and consumer discretionary stock picking. This is another massive fund, over $725 million in assets, and F5 Inc. is back, this time as their top holding at a very significant 8.5% for this fund. Now for the High Yield Fund. Class A cost $95, 0.91%. Performance, 8.63%. This fund actually outperformed its benchmark, the ICE BofA US Corporate Bond Index, which returns 7.03%. The report highlights credit selection as a win, especially in basic industry and capital goods. They also benefited from being overweight in the BBNB rated bonds. However, energy credit selection and being underweight in banking hurt them. This is another giant fund with over $775 million in assets. It seems that when they focus on bonds rather than stocks, they can outperform. Top issuers include CCO Holdings at 2.3% and Carnival Corp at 1.5%. These are mostly corporate bonds as expected for a high yield fund. A portfolio manager change for the high yield funds, Daniel McKenzie, is now on board. All right, let's look at the SMAHAP Diversified Value Fund. This is a newer fund incepted in March 2025. It returned 2.15. It returned 2.14 in 25. The report mentions that information technology stock selection and over underweight positions in energy and technology detracted from performance. This fund is very small with just over $2 million in assets. Naturally, the top holdings are tiny percentages like Synchrony Financial at 1.2%. Finally, we have the HW Opportunities MP Fund. This one is interesting. It has a 0.00% cost. Yes, you heard that right, zero cost. Performance-wise, it returned 4.26%, significantly underperforming the Russell 3000 index's 15.3%. So free might not always be best. Top holdings include U-Haul at 8.0% and Havas NV at 6.6%. It's a bit of a mixed bag in terms of sector concentration here. Looking at item 8, there were no changes in accountants or disagreements. That's generally a good sign of stability. For audit fees, the company paid around $269,000 in 2025 and $250,000 in 2024 to Deloitte and Touche LE. No other significant fees were paid to them. The audit committee has policies in place to approve all services provided by the auditors. They also delegate some approval to the chair for smaller engagements. The auditor's report confirms that the financial statements are presented fairly. They've been auditing for the company since 2012, which shows a long-standing relationship. Overall, it seems like a mixed bag. Many of their stock funds significantly underperformed their benchmarks, particularly the Russell 3000. The reasons cited, like stock selection and sector overweights in energy and healthcare, are recurring themes, suggesting a potential issue with their investment strategy or execution in certain market conditions. Warren Buffett always tells us to look for companies with enduring competitive advantages, and here one can question if these funds consistently demonstrate that, especially as they lag market indices. The international value and international small cap funds did shine, outperforming their benchmarks, which indicates some success in specific niches. The high yield fund also beat its benchmark, showing strength in fixed income. However, the sheer number of funds underperforming the broad market is a concern. They're managing billions of dollars, and if even a small percentage underperforming, that's a lot of lost opportunity for investors. A notable risk is the heavy concentration in F5 Inc. across multiple funds. While it might be a strong company, such a significant holding in several portfolios could indicate a lack of diversification or an over-reliance on a single stock's performance. The name change for the large cap disciplined value fund and the leadership change in portfolio management for some funds can be seen as attempts to refresh strategies or address past underperformance. The mid-cap diversified value fund and HW Opportunities MP fund are newer or have specific distribution models, making their performance harder to judge in the short term. The HW fortune is also quite low, raising the question of whether free is truly valuable if it doesn't generate competitive returns. In conclusion, while Hotchkis Wiley manages a lot of money, their stock-picking funds appear to be struggling against broad market indexes. Investors looking for broad market exposure might be better served by index funds, while those seeking alpha might want to look closely at the specific strategies and performance of the funds that did outperform, like the international value and high yield funds, before investing. Alright, that's our dive into Hotchkis Wiley's latest filings. What do you think about their performance and strategies? Let me know your thoughts in the comments below. If you found this breakdown helpful, hit that like button, subscribe for more corporate deep dives, and join our Discord community linked in the description for more discussions. Thanks for watching, and I'll see you in the next episode of Corporate Decoder.